Good morning, good afternoon. We admire your fortitude if it is evening, so we appreciate you joining today. The webinar that we're going to do is called US and Gulf of Mexico Crude. What we're going to do is we're going to give an outlook on production, flows, and freight. So in terms of who's presenting today, we've got Alexander Andlauer. He is our Senior Global Energy Analyst at Kpler. Myself, Matt Smith, Lead Oil Analyst in Americas. And then finally, we've got Matt Wright, who is our Senior Freight Analyst. So what we're going to do, Alex is going to kick off. He's going to give our production outlook for the US, for Gulf of Mexico, for Canada. I'm then going to take that and explain some of the flows that we're going to see because of that. And then finally, Matt Wright is going to take it from there and assess what all of that means for the freight market going forward. You have the ability to ask questions as well in the Q&A box there. We'll get to those at the end. So without further ado, what I'll do is I'll throw the ball straight to Alex and he can give you his outlook on production. Over to you, Alex.
Yeah, thanks, Matt. And I will start with shale oil. So it's nothing new to say that production has been volatile over the last few years. With oil price decreasing, as you can see on the chart, the US shale oil production declined by more than 2 million barrels per day since its peak in November 2019. Last year, we saw production increasing again, driven by the Permian Basin and also uncompleted wells, meaning that only fracking was needed to start production. We had some extremely cold winter that hit production in February, and that means that the average 2021 production came a bit lower. But more importantly, it's capital discipline from oil company which limited the upside for more volumes in 2021. This has been a request actually from shareholders of public companies. After years of loss, they wanted to see higher return, more dividend. For your information, the current dividend yield from shale players is 4 times higher than the S&P 500, which clearly highlights that oil company management followed the request of their shareholders. But as cash flow have been strong in the second part of last year, debt level came lower, dividend yield higher as mentioned, and with WTI above 80, we see a greater temptation to boost cash flows through higher volumes. We clearly see that when prices are above 80, it's a catalyst as there is lower debt, even if it's not an homogeneous amongst all producers. As a result, based on Q4 earnings release and management conference call, investment should be up by 20% in the US shale oil and support growth of almost 1 million barrels per day on average in 2022 compared to 2021. The Permian Basin should remain the driver of the market, with almost 60% of the growth coming from Texas, especially in the first half of the year. The current production is for an increase of 100 KBD every month. If we move to the next slide, we see confirmation of the high confidence for 2022. Indeed, the latest Dallas Fed survey highlights the strong confidence amongst oil management, and this is also what we have seen during Q4 earnings release. Halliburton and Schlumberger, the 2 biggest oil services in the US, highlight higher capacity, higher activity, higher activity with well completion service approaching 90% of utilization. Halliburton is, by the way, sold out. We therefore see labor and equipment shortage as a limit of the production upside for 2022. Due to less capacity, of course, there will be also some inflation on wells, which could be between 10 and 20%. In addition, it's important to highlight that last year, and that's what I said earlier, the cash cost to add new production was low, as the uncompleted wells were the first completed. This is what we can see at the bottom of the chart. The inventory of drilled but uncompleted wells decreased, and it is at an historically low level. Drilling is usually 30 or 40%, 30 to 40% of the cost of a well. So the cash expense, I clearly mentioned here, cash from a cash point of view, was lower to add production in 2021. In 2022, we have therefore to drill more, to frack more. And this is a trend, what we can see at the top chart, with rigs at the highest since COVID-19 started. The blue line is the permanent, and of course, it's the driver of the growth. Conclusion on shale oil is that, first of all, production could rise up to 1 million barrels per day in 2022 with a strong H1, but at a higher cost than in 2021. This put at risk next year production growth, all else remaining equal. Shale oil is not the only unconventional oil benefiting from higher oil prices and confidence in a multi-year cycle. That's the case also in Canada. We move to the next slide. In Canada, actually, the oil sand business model is different from shale. The production decline is much lower, so less capital expenditure is required to increase production. We know that many majors have left the country and Canadian oil sand due to greenhouse emission and low return. But like on shale oil, the picture is changing. On's price reached $80 per barrel. Investment should rise by 20% compared to last year, of which $5 billion is allocated to oil sand. If we have a look on what the oil sand players have provided in terms of production guidance in Q4 earnings release, it looks clear that production 2022 is on track for another year of record output. As example, Imperial Oil should see its production grow by 12%, Suncor by 7%, Cenovus by 6%. And instead of launching new projects, Cenovus plans to raise production through small expansion and reducing bottlenecks. All companies should benefit as well from increased pipeline capacity. So altogether in Canada, when we combine oil sand and conventional oil, we see production could be up by 0.3 million barrels per day compared to last year, of which oil sand accounts for 2/3 of the growth, despite some cold weather and some disrupted operation last month. Lastly, when speaking about North America, it's worth mentioning as well Gulf of Mexico. So offshore Gulf of Mexico is often viewed as a rock-steady player in the U.S. crude oil production. Wells in the region are typically maintained at high level of production years after years. As a reminder, when oil price crashed in 2020, the production decreased by 16% between March and April as producers preferred to shut down wells. Last year was already a productive year for the region as several projects operated by major came online, including in September, the extension of Thunder Horse. The current production right now is at 1.8 million barrels a day. That should increase in 2022 thanks to 10 major projects that should start, including MacDoc 2 and Vito. But there are also some smaller fields that are expected to start, which are all linked to existing infrastructures, and that support the production increase. We had as well a cost reduction because the project development cost halved over the last 10 years, divided by 2, and it's right now at $10 per barrel. Here I'm speaking about project development cost, not the break-even, which is rather around $40 a barrel. That has been possible thanks to smaller platforms, which are more standardized than it was before, and that has been key in cost reduction. So in Gulf of Mexico, we expect production to grow by 150 KBD, reflecting the fact that production from new wells will outpace the gradual slowdown in output from existing wells. So if we integrate all together, US shale, Canada, Gulf of Mexico, we could see production up to 1.5 million barrels per day compared to last year.
Okie dokies. Thank you so much, Alex. Okay, so from Alex's projections on the production side of things, We're then going to take those and take a look at what we believe that means going forward here for exports, for imports, and the US crude balance. So here, what we're looking at is forecast for US crude exports for this year. Not surprisingly, we're seeing them higher because of higher production. But we're not actually seeing any new projects coming online this year. Indeed, there's nothing coming online next year either. We think the likelihood is that we get 1 or 2 projects potentially done that come online in 2024, and that'll be it. There's the SPOT project, the Seaport Oil Terminal from Enterprise off of it. It's an offshore buoy off of Freeport there in the Houston area, which can fully load a VLCC. That could potentially get done in 2024. That's kind of leading the charge at the moment. There's also the Blue Marlin project as well from Energy Transfer, looking at a similar thing off of Louisiana. But what we see in terms of the growth for this year, we see it coming through in terms of incremental barrels added and loaded from already existing docks. So if you just look at the chart here where you've got the kind of the big blue bar and then the orange bar, that is Corpus Christi and Houston. And they essentially provide a base load for US crude exports. So we see them providing about 2.4 million barrels a day, something like that. If you took Enbridge's Ingleside Energy Center at Corpus Christi, which can partially load a VLCC, you take the Buckeye South Texas Gateway Terminal at Corpus as well, which can do the same, and then you add in Enterprise's Houston Terminal, those 3 load points on their own account for nearly 48% of US crude exports. And so you've got that kind of base load there. But what we see going forward here is we're going to see sort of incremental additions. One key development, or a couple of key developments that we've seen in the last few months, is more Canadian crude making its way down to the US Gulf. So we've had Enbridge's Line 3 replacement line come online there. That's essentially sending crude into Wisconsin. You've also got the reversal of the Kpler pipeline late last year, which is sending crude from Patoka, Illinois, down into St. James. And indeed, we're seeing some loadings from there, from New Star, which we haven't seen since like March, something like that. So you've got more Canadian crude coming down into the Louisiana area there. But that's going to cause one of 2 things. Either one, we're going to see higher exports of Canadian crude from there, which we saw reach a record in December, close to 300,000 barrels a day, or we see those Canadian barrels consumed regionally there, and you see them displacing something like a Mars barrel, and we see increasing exports of that. Either way, the development with this more Canadian crude coming down to the US Gulf means we're going to see higher exports. There's also a couple of other projects too. So we've got Bakken crude, which we haven't really seen exported in the last year, is going to start up again from Nederland with the Ted Collins line coming online. We also have Wink to Webster, which is sending Permian crude to Texas City coming online too. So you've got these incremental developments. And so we've got the base load of the big hitters there with the addition of, say, more coming from potentially St. James, potentially Loop, potentially Beaumont. So that's why we see exports around 3.15 million barrels a day on average this year. That's up about 350,000 barrels a day versus the average of 2021. So if we're taking Alex's production forecast, and then we've got our assumption in terms of the export side of things, we've got a view on imports and our view on refinery runs as well, we can then look at what we think the holistic US crude balance is going to look like and end up at the end of this year. So there's 2 key stories here really. The first is that we're going to see commercial inventories continue to increase through the next few months, through April there. And that's in part because we're going to be seeing seasonal refinery maintenance, but it's predominantly going to be driven by SPR releases that are making their way from the Strategic Petroleum Reserve into commercial inventories and buoying them. The second piece of this, of all of this, is that as we then move through the summer, we see refinery runs really starting to ramp up. Summer driving season, driving on demand, international demand for US and Canadian barrels in terms of exports means we're going to see draws coming through in the summer. One thing to bear in mind is, refinery runs were, low last year because of the pandemic. We see them averaging about 770,000 barrels a day higher in 2022, averaging around 15.8 million barrels a day. Same time too as well, we referenced Canadian in the last slide there. We're seeing that showing up. It's already been seen in the monthly data from the EIA. So their latest number reported last week for November shows Canadian crude imports into the US at 3.9 million barrels a day. We expect we're going to see them climbing above 4 million barrels a day, being at a record this year. Put all those pieces together, we still expect that by the end of the year, we're going to be below 400 million barrels in terms of US commercial inventories, which is important because we haven't been at that level since early 2015. So that's a near 8-year low. So that is a pretty constructive picture when it comes to the US crude balance. If we then take a look at the balance from a seaborne perspective of what's coming in and what's going out, what this chart is showing you is those net flows essentially. So if you look to the bottom left of this chart for Jan 2017 there, the US and PAD 3, the Gulf Coast there, was importing far much more crude on a seaborne basis than it was exporting. But as you can see, there was an inflection point in January 2019 as US production continued to increase, US exports continued to increase. And then for the past few years, we've been seeing the US Gulf as a net seaborne exporter of about 2 million barrels a day. We expect that to continue going forward here. One, because of the export side of the picture where we're seeing that strength coming through, but also because we're going to be seeing subdued seaborne imports. And the reason for that is because partly again, back to Canada, we're seeing more Canadian crude coming down, but also US refiners in recent years have been consuming more US crude and shifting to a lighter slate. So there's just that lesser need for foreign barrels to be coming in to the US Gulf, particularly lighter barrels. So then if we just take that to my fourth and final slide here, and just looking at the import side of things, what this chart is showing you, you've got the light blue line, which is essentially horizontal there. That is Mexican crude imports into the US Gulf. So pretty much a base load of heavy crude there. What the dark blue line is that starts top left and then works its way lower, that's seaborne imports from everywhere else. And you can see that those have been marginalized from 2017 to 2019 there. And again, that comes back to, in part, the rise in Canadian flows. It also comes back to Venezuelan sanctions, so no more Venezuelan barrels coming into the US, but also just the lesser need for foreign barrels. And so it's kind of pushed out those Middle East barrels, so Saudi, Iraq, taking a big dent. And so really what you've got now is Mexican heavy Maya crude has essentially stayed fairly flat there, but it accounts for about 45%, 50%, something like that, of total waterborne imports. Nothing else is really needed in terms of the heavier crude. You're getting that sort of, what, 515,000 barrels a day from Mexico, and you're getting about the same from everywhere else incrementally. So very much reliant on those Mexican barrels. The reason for flagging this is because AMLO, the Mexican president, is focusing on potentially removing or dialing back on all Mexican crude exports to keep them at home for domestic use. Now, we're not making a judgment call on whether we're going to get to zero or that, but we think that that could have an impact by the end of the year, an incremental impact going forward there. If that does happen, the US is going to have to be looking for a replacement barrel to replace those Mexican heavy barrels, but that will all it will be. So it may come from elsewhere in Latin America. We may have to go to the Middle East and try and bid those barrels away from Asia. But really here, the key takeaway is that the US Gulf is just dependent upon a base load and nothing else more than that from the import side of things. So we've explained what we see on the production side of things, how we see that impacting the imports and the exports. So what I'm going to do now is pass over to Matt Wright, Senior Freight Analyst, and he'll explain what all that means for freight markets going forward.
Yeah, thanks, Matt. So we're going to take a look at some trends from last year and then give our outlook for exports by vessel type for the coming year. So starting with VLCCs, the US Gulf is quite a small VLCC market in the context of the global market. It makes up around 7% of VLCC trade. For comparison, the Mideast Gulf is around 67%. Total exports from on VLCCs from the Gulf fell 6% last year. This was largely as a result of a weak start to the year and compared with the strong middle of 2020. Exports did end the year on a high, however, supported by strong demand from Asia, which included that 300 kbd or so of Canadian crude via the Kpler reversal. Heavy grades are popular in Asia, so all of this was shipped on VLCCs. The number of loads from terminals from the Gulf increased last year, even as total exports declined. So this is a sign that reverse lightering is dropping, increasing vessel efficiency. Despite the comparatively small size of the VLCC market that I mentioned, it can actually have quite a large impact on the benchmark VLCC rate. We saw this trend towards the end of last year. And if you look at the chart on the right here in the period with the red arrow, the increase in VL exports from the Gulf from late October through to December contributed to an increase in the Mideast Gulf to China VLCC rate. And this occurred because the increase in volumes from the Gulf drew in more ballasters into the region that would have otherwise returned to the Mideast Gulf, keeping the sort of the ship count in the area down and allowing rates there to firm. However, this effect is generally more prominent when the market is relatively weak, as it has been for the last 18 months or so. So, you know, it not necessarily will see something in a stronger market, but just to highlight that for a small market, it can pack a punch. Voyages from Atlantic ports in general to Asia tend to pay better than they do from the Mideast Gulf. And this is just to encourage vessels to make the long ballast voyage. And moving on to Suezmaxes now. So so this is the smallest of the three segments in volume terms. After a weak 2020, when Aframaxes and VLs did significantly better, demand has bounced back quite a lot with higher volumes to Canada, Europe, and Asia. There is a lot more volatility in both demand and in the destinations for Suezmaxes from the Gulf. It doesn't have the same base load of exports as the Afras and VLs do, and it tends to act as a link between the two and in certain periods. So whether this is picking up loads to Europe when the Afro market is a bit firm, or barrels to Asia when there's an increase in demand there. Because it covers a wide range of destinations, ton miles from the vessels can swing significantly. So I've highlighted this in the chart here, and the light blue line does show that even when exports are comparatively steady, there can be large swings in ton miles. And this is, you know, reflects the fact that 1 month, the majority of barrels might go to Asia and the next to Europe, which is obviously a shorter voyage. And so the ton mile effect is more muted. As a result, what this can do is it can make vessel supply less secure because you don't have the same regularity of returning ballasters to the region. So turning to the Aframaxes now. The Gulf of Mexico is the largest Aframax market in the Atlantic. This isn't taking into account the Baltic in the North Sea, obviously. Exports and ton miles on Afras fell 16% last year. It was the largest decline among the vessel types there. This was mainly because demand was returning to previous levels after a particularly strong period in 2020, rather than a true loss in demand. However, there has been a declining trend in Aframax demand in the region over the last few years. In addition to exports to Europe, the other major route in the region is the cross Gulf of Mexico trade from Mexico to the US. There's been a slow decline in volumes over the last year, which is cutting overall demand for Aframaxes in the region. In general, the number of Aframaxes in the Atlantic on the whole has been in decline. And I've highlighted this in the chart here, the orange line shows that. But it will remain the dominant vessel type, particularly carrying crude to Europe. The decline in Aframaxes is sort of a symptom of a few things. We've got, beginning in 2019, the loss of Venezuelan barrels there saw quite a significant drop. The volatility during since COVID has you've seen periods of higher exports, but generally there's been a downward trend, which has just seen the required number of Aframaxes fall. In addition, as Matt mentioned, the US is dependent on those Mexican grades, And as almost all of this is carried on Aframaxes, and as the US is likely looking to protect its market share, even if Mexico looks to reduce export volumes, this will sort of guarantee employment for the Aframax market in the Gulf over the coming year. So on my last slide, we're just going to look ahead to the rest of the year. So following on from the export projection that Matt discussed, we've got the same outlook here, but this time just divided by vessel type. And it's largely business as usual. The splits between the sectors are holding broadly steady, I'd say, but we do see a slight increase in Aframax and VLCC loads as a share of the export market. So starting with the VLs, we expect to see growth in volumes, but this will depend on the demand appetite from Asia. So there's less opportunity, we think, from China due to the cut in the crude import quotas for independent refiners, but South Korea and India will be key here. It's important to note that OPEC Plus has been struggling to increase production in line with its planned 400 KBD per month target, and exports from the group actually dropped 800 KBD last month. This could present an opportunity as China and other consumers in Asia look to sort of ramp up their imports. There could be some incremental demand for Atlantic Basin crudes if Asian demand grows faster than Middle East export growth. So that could be something to keep an eye on. The Gulf of Mexico, which includes Mexico VL export volumes, is set to become the largest VLCC market in the Atlantic as West African volumes continue to decline. This could accelerate further if the long-awaited Dangote refinery comes online towards the end of the year, as the company intends. This would see more ballasters in the Atlantic head over to the Gulf rather than other load regions, which would put pressure on rates. But and as Matt has pointed out, the import volumes coming into the Gulf have been in decline, which has reduced the number of natural backhaul opportunities, meaning exports from the Gulf will be more reliant on ballasters to the region. We project an average exports on VLCCs of 1.3 million barrels per day, which is a 16% increase year on year. For the Suezmaxes, after a return in demand last year, we expect to see a continuation of this trend, with these vessels picking up cargoes across the destination spectrum, which should lift exports by about to 620-ish KBD, which is about a 14% increase year on year. We expect this to come from an increase in flows to Europe, but the bigger driver of ton miles will be exports to Asia, particularly India. And then finally, on the Aframax side, we expect to see growth in exports, but at a lower rate of about 10%. This would still be average exports of 1.2 million barrels per day, but it would mean a falling behind VLCCs in terms of market share. This is mainly due to slower growth in exports to Europe compared with Asia, and a slightly higher share of the European market taken by Suezmaxes. However, this is a very slight shift, and Aframaxes will remain the dominant supplier to Europe, and the downward trend in cross-Gulf activity isn't really expected until later this year, if at all. So this brings me to the end of the freight section, so I'll pass back to Matt to wrap us up.
Super, thanks, Matt. Okay, so in conclusion, just looking at the three elements that we've discussed today. So in terms of the production side of things, we're looking at shale production ramping up to be higher by up to 1 million barrels per day versus last year. Not only that, but we're looking at the Gulf of Mexico adding production of about 150,000 barrels a day, and Canadian production adding 300,000 barrels a day. You combine the three of them and you get to nigh on 1.5 million barrels a day of growth. So very strong from the production side of things. That should then be reflected through in both the imports and the exports, subdued imports and higher exports. We're looking seaborne exports getting up to average 3.15 million barrels a day. That's 350,000 barrels a day higher than last year. Record Canadian crude imports are going to help offset that need for heavier crude imports. So we should see seaborne imports into the US generally remaining fairly subdued. And then what that means for everything as we see refinery runs really ramping up is that we see crude inventories finish the year close to those beginning of 2015 levels, sort of 8 years ago. Then on the freight side of things, So with the increase in exports that we're seeing, that should be to the benefit of all vessel types, but particularly given how much we're seeing long haul to Asia there, that will support Suezmaxes and VLCCs. On the Aframax side of things, they're going to potentially be under some pressure because of declining activity in those Gulf of Mexico flows, and as well as competition from Suezmaxes into Europe. So with that, that's our conclusion. We will open it up to any questions that you may have. You'd be able to pop them in there. I can see some just coming through here now. All right, so Alex, I'm going to put you on the spot first of all, if that's okay. We've got a question coming. What can we expect for 2023 on shale oil production for the US? What could change your view on 2022?
Okay, to start with the second one, 2022, there's little things that could change the picture, excluding a sharp decrease on oil price in the next 3 months. But it looks like that for H1 it will be anyway strong. So little things that could change the picture for this year. It will be more for next year. And actually for next year, as I mentioned, the inflation is not supporting for a growth of 1 million barrels per day in 2023, and also the base of decline of production will be higher, as 2022 is extremely good year for production. So 2023 should probably not be as good as 2022, let's say, with the current oil prices.
Thanks, Alex. Just looking, we've got quite a few questions coming through here. Okay. Oh, they're firing them through. Okay, so first question we've got is, looking at heavy grades for PAD 3, do you think Brazilian crude could be a potential market here in the future instead of relying on Mexican, Canadian or Colombian crudes? Probably not from the Brazilian side of things. You know, we have been seeing that being pulled to China, and even as we've seen, imports drop off to China last year. We haven't seen Brazilian picking up into the US, and so suspect that we may see Middle East barrels pulled across, but really our base case is still that the Mexico may be more talk than actual action, and so we should continue to see those exports coming in into the US, particularly given part of those are going to be coming into Shell Deer Park when Pemex fully takes ownership of that. We'll still see those flows coming in there. We see, I think it's like 60,000 barrels a day from Mexico currently. We should see that higher from there. So it may not be too much of an issue. And I think it'll be that proximity thing where we'll rely maybe more on some Colombian crude as well. So, but not on the Brazilian side of things. Question for Matt. Do you think the USG market is going to support VLCC rates this year?
Yeah, good one. I think it will to an extent, but I think we need to just keep in mind that it is a small VLCC market. So any impact it's going to have is going to be muted by whatever is happening in the Middle East Gulf. I'll just tack on because there's been another question come in just around the Iranian VLCC fleet. So is this taking into account that? And I think we're not at the moment, but I think I wouldn't be changing our outlook for the US Gulf significantly in terms of where we're saying in terms of demand for the vessel types there, significantly based on that. And the reason for that, I think the return of the Iranian fleet could have a significant impact on rates and on the market. But in terms of movement of flows, I think you're going to see a lot of the heavier Iranian grades maybe displace other Middle Eastern grades. And then in terms of the condensates, there is a potential for it to hit some of the US condensates, particularly to South Korea. But we haven't taken that into account in our current outlook, no.
Gotcha. Thanks, man. Okay, Alex, another one for you. For Gulf of Mexico, 150K production growth, are those growth from new projects or current oil wells?
That's coming from new projects. There are 10 major that will be that are expected to start in addition to some small ones. So it's clearly coming from new one, and next year should also see further production grow as there are some other project that should start that we already know for 2022. So the decline rate is slower than what we had a couple of years ago, but it's clearly, again, we need more projects in Gulf of Mexico to increase production, not as much as shale oil, of course, but we need some new projects.
Gotcha. Thanks, Alex. Just sifting through, and if you guys see one you want to grab as well, but there's ones you suggested US runs to average 15.8 this year. Where do you have summer peak throughput? I believe it's about 16.2, something like that, 16.3 for kind of July, August period. So getting up there and then averaging lower, obviously with the shoulder months as we see some seasonal maintenance coming up next month, and also for September, October time. There's another question. How is the low level of Cushing inventories affecting your assumptions, if at all? I can take that one, in that we're tracking, your clients, we're tracking Cushing via drone. The mid-week level actually that just came out yesterday shows that we've dropped again. So we've now dropped below the November low. And so we're down to a kind of multi-year low there. It's dropping sort of below that, close that 31 million barrel mark. And so with that, you're essentially going to have those Cushing barrels pricing to stay there rather than being pulled down to the Gulf. So because of that, we have made, in our forecast, if you have a look at it, you can see that the low point for this year in terms of crude exports, we've got that coming next month. Because we expect that those low Cushing levels will have a crimp on that. That's it going forward here. A house view is that we should see Cushing continuing to draw, but probably to the mid-20s, something like that, and nothing further than that. So, but we should see that reflected on a little bit of a crimp on the crude export side of things. Just going through.
There was a question on what about exports to Europe and the Med? What is the view in terms of crude grades for 2022? Matt and Alex, I'm not sure if you have an opinion, but my thoughts on this are we'd probably just see more of the same, which is US lights. In terms of from the vessel type, I think it's going to be more Afras and Suezmaxes definitely. But yeah, I just say in general, probably just more of the same that we've seen over the last year.
Absolutely. Yeah. So when you look at US crude exports, they are split basically 86% of those are your light sweets, and then the other 14% is split between heavies and mediums. So Canadian heavy, and then your mediums such as a Mars crude. And as you've said, Matt, where you have those heavies pulled off to Asia, not going into Europe there. So we should be seeing that being the light sweet crude continuing to go there. Makes sense. And I think we have like a commensurate rise in terms of what we see going in there. Last year was about 1.1, something like that. So we see it a little bit higher than that for this year, 1.3, I think, something like that. Okay, so there was a question. What would you consider to be the most significant Asian crude demand indicators going forward? So one thing we're really watching is in terms of the Chinese onshore inventories there. And so, that trend where we saw them drawing on those inventories last year rather than buying higher priced crude for imports. But we've seen the imports bottom out last year in sort of October time, and then they've started to increase that buying, whether they did that on the dip that we saw in Q4 there, but we're seeing those inventories increasing there again now. So we'll be keeping an eye on that, particularly as we see their refinery runs start to increase. Their runs are low at the moment given the Olympics and the need for the lack of pollution, but also in terms of Lunar New Year and having a bit of a lull there. But that will be something to watch going forward in conjunction with the import volumes going in there. And then secondly, Indian oil imports, because, you know, trying to find somewhere for where we see real strength coming through, both from an economic and a crude flow perspective. That's India's your base case there. So that's one thing as well, as a real kind of litmus test to see the health of Asia. I think we've got them all, guys. You see, I'm just scrolling through here. I think that's everything. If you do have any more questions, please feel free to send an email to research@kpler.com. We'll be happy to reply. If we see anything else that we've missed here, we'll address it as well. But thank you very much for joining. Really appreciate it. And have a great rest of your day or evening.